How does spousal inheritance of an IRA work? Have you ever wondered what happens to an individual retirement account when a spouse passes away? Understanding the options available for spousal inheritance of an individual retirement account is essential for effective retirement and estate planning. Let's break it down in simple terms. When one spouse dies, the surviving spouse can inherit the individual retirement account. This account can either be a traditional individual retirement account or a Roth individual retirement account. Each type has different tax implications and rules for distributions. The first option for a surviving spouse is to treat the inherited individual retirement account as their own. This means they can transfer the assets into their own individual retirement account, whether it is an existing account or a new one. By doing this, the account is treated as if it was originally theirs. The best part? Required minimum distributions do not have to start until the spouse reaches age 73. However, if they take money out before age 59 and a half, they may face early withdrawal penalties, unless certain exceptions apply. This option allows the account to continue growing tax-deferred or tax-free if it is a Roth individual retirement account. The second option is to keep the individual retirement account as an inherited account. In this case, the surviving spouse does not combine it with their own accounts. Required minimum distributions must begin by the end of the year following the original owner's death or when the deceased spouse would have turned 73. Whichever is later. The distributions are based on the life expectancy of the surviving spouse, and there are no early withdrawal penalties, even if the spouse is under 59 and a half. Now, let's talk about Roth individual retirement accounts. If a spouse inherits a Roth individual retirement account, they can either transfer the assets to their own Roth individual retirement account or keep it as an inherited Roth individual retirement account. Distributions from a Roth individual retirement account are tax-free if the account has met the 5-year holding period. It is important to note that, if the spouse treats the individual retirement account as their own, they will follow standard required minimum distribution rules based on their age. However, if they keep it as an inherited account, required minimum distributions must start sooner, following Internal Revenue Service guidelines. Failing to take required minimum distributions on time can lead to penalties of up to 25% of the amount that should have been withdrawn. Understanding these options can help in retirement planning. Treating the individual retirement account as your own can simplify management and delay distributions, while keeping it as inherited may be beneficial if the spouse needs income sooner. Properly managing the inherited individual retirement account can support financial security throughout retirement. In the end, the choice between treating the individual retirement account as your own or keeping it as an inherited account depends on various factors, including age, income needs, and tax situations. Each option has its own set of rules for distributions and taxes, so it is wise to consider all aspects before making a decision.